Well, I think if you look at those two markets, they're really quite different, of course. I was just listening to the commentary around the building construction and particularly for residential in China. And yes, we're seeing that soft. The impact in China for us is the potential impact on steel prices in the ASEAN region and what that does to our Australian pricing. But we're watching that closely. The US economy remains surprisingly strong for us. Automobile purchases are back above 15 million. We're seeing still good activities in industrial and commercial. There's a lot of money being invested in the United States economy, so I'm probably more moving towards the softer landing theory with the US economy, just given the amount of reshoring investment that's occurring, the IRA Act. There's a lot of investment that's happening in the US economy.
But in that respect, if we were to see, a soft landing in the US economy, perhaps China isn't as bad as people are expecting right now. Does that hurt you, though, in some respects as well? Because you'd have a reasonable expectation, because commodities have been pricing in a recession, even though the markets, generally speaking, haven't. That met coal prices might go up, some of your input costs might track a little bit higher. Is that something that you're thinking about?
Yeah, it's something that we obviously watch carefully. There's been a reasonable level of consolidation that's occurred in the US economy. We've also seen some of that inflationary impact flow through to our costs, but that to date has largely been reflected in the sell prices of our products in those markets. Our spreads, as we call them, or the difference between our sell price and our raw material price, has been more challenged in Asia, and that's been partly because of the softening in China and some of that steel production coming out of China and flowing into those ASEAN markets and depressing the sell price for steel.
Right, Mark, I do want to get a sense on how you're looking to top up your share buyback and what's compelling you to do so at a time when there is pressure on the business. While you're, of course, facing this tough environment head on, I just want to get a sense from you on what sort of signal would you like to send out to investors?
Yeah, well, I mean, we had a really strong result. As was noted, we're off the very high cyclical results that we saw in FY22, but our $1.6 billion of underlying EBIT was the third strongest EBIT that we've ever had as a company. So far from being a terrible result, it was still a very strong result. We've got a very strong balance sheet. We had more than $700 million on cash at bank at the close, and the board is confident enough to maintain our dividend to 25%, 25 cents share, fully franked for the final dividend, and we've effectively topped up the buyback to make it a $400 million buyback over the next 12 months. So the signal we're sending is the company's in very good financial health. We've got a strong outlook for the next 6 months, and we feel it's appropriate to give some of that return back to our shareholders.